Um, Good morning, everyone, and thank you for joining us for our latest webinar, which is everything you need to know about shares. So I have a quick introduction. My name's Mark Rubinson. I'm a partner of Aaron Berlin Gardner, and I'm joined this morning by our tax partner, Victor Dulp. Many of you will already know that we hold these events usually at our City Road offices, and we have, I'm delighted to tell you, we've been actually scheduled our first real life event for quite a long time, for September. So all being well, we'll see you all back at the offices in September for a real life seminar rather than a webinar. When I do these intros, I usually spend a little bit of time talking about how Spurs are getting on, and it's been a very interesting week for any Spurs supporters, and we look forward to our cup final on Sunday. In fact, today's talk is going to be about 10 minutes about Spurs and about 15 minutes about tax, so just forewarn you on that. Not really, actually. This is our fifth webinar. We've done 4 prior to this in this year. The next session will be 20th of May, and Tim Palmer, who's our tax consultant, will be looking at stamp duty tax planning. And we've got another session planned for June when we'll be looking at how business can trade out of the COVID pandemic. Today, though, we're looking at shares. I'm going to start us off with a brief overview of options available to you, and then Victor will look at some of the intricate details. We will take questions and answers, so if you have questions, you will see a chat box, or you should see a chat box at the bottom of your screen. Type in your question and we will endeavour to deal with it during the time. If there isn't time and we're conscious that you've got other stuff to do, then we will get back to you after the session's finished. You might know a little bit about me. I'll give you a bit of an intro on Victor. Victor's our tax partner. He's a published author and he sits on various tax committees and subcommittees, as well as appearing in the Spears 500 as one of the UK's most highly recommended tax advisors, a real top tax person. So at the end of the webinar, you'll receive an email which will ask for your feedback via a Google form. Very, very important to us. Would be very grateful if you could complete the form, and as it helps us improve things moving forward. Okay, so let's get going. Everything you need to know about shares. So what we're going to cover today is growth shares, EMI share options, alphabet shares, and employment-related securities legislation, why that can be problematic, passing shares to family members, EIS and seed EIS, business property relief, and business asset disposal relief. And there might be one or two other things that we will throw in. So growth shares, we love growth shares. Growth shares have been around for quite a while, but we find they're not used very much. And often we take on new situations, new clients, and they've never heard of them, which is very good for us. Very, very good. And I'll explain exactly how they work. So you've got a nice company, let's say it's worth £5 million, and you get a super new person joining you, and that person will only join if they get shares. So what do? You've got, broadly speaking, you've got 3 options. You suggest EMI share options, which I'll come on to, and that doesn't do it for him. He doesn't want options, he wants real shares, and he wants them now. You can give him actual shares of the company, but as I said before, the company's worth £5 million, so 10% stake is worth £500,000. Are you going to ask your new employee to write you out a cheque for £500,000? Probably not. You probably won't be able to, and it's not a good way to start a relationship. So what can you do? If you give him 10% shares, the company issues 10% shares, you give him 10% shares as an employee, he's got something worth £500,000. And you won't be surprised to know that he will have to pay tax on that. He will get zapped for tax under employment-related securities legislation, and there'll be horrible amounts of tax and probably national insurance as well. So not a great start. So what do? What you can do is you can say, okay, I've built the business up, I built the company up rather, I've got it to where it is now. In other words, it's now worth £5 million thanks to my efforts. I'm more than happy to share with you moving forward. You help me grow this company, you help me increase its value, and you will share in the uplift. So by way of example, again, company's worth £5 million today. The guy or lady gets issued with 10% of shares, but there's a bar there, there's a limit. So if in future the company is sold for more than £5 million in shares, but only over £5 million, So in 3, 4, 5 years' time, the company gets sold for £12 million. There's been an uplift since the person joined of £7 million. He will get 10% of that £7 million uplift, in other words, £700,000. He won't share in the value as of today, he'll only share in the value moving forward. What are the advantages? The advantages are he gets his shares here and now based on the current valuation, which means no tax. There are zero tax implications. In the real world, if the company's worth £5 million, we would probably suggest that the bar is set a little bit above £5 million. Otherwise, HMRC might have a much closer look at it. So it may well be that the bar is set at, for example, the value over and above 5.5, or maybe over above £6 million. That's for a quite life and to be very cautious and safe. But it's a brilliant way to get someone shares to avoid any tax issues under what's called employment-related securities legislation, and it gives them real shares here and now on which they will get real dividends. So the bar is set based on the current value, maybe a little bit above the current value. The person gets real shares, and there will be obviously documentation. You may well change the memorandum and articles of association as a result of that. And I'll repeat on more than one occasion that with this and with a lot of other situations, what you need, what you want is a shareholders agreement. You want to have something in place if it don't work out. And I assume we've got lots of our solicitor friends watching. I'm sure one of them will be delighted to help you if you want to do this type of things with a shareholders agreement. Very, very, very important. Everyone hopes that this works out well. It's like a marriage. Everyone's in love on day one, but sometimes these things don't work out. And by way of a shareholders agreement and possibly other documentation, you can work out how the scenario can play out if it doesn't quite go to plan. But the point is, an amount is set, probably go slightly above that amount. Anything above that, your new employee will get a share of the uplift as and when you sell the company, and he or she will get dividends as you move forward.
If I could jump in there, Mark.
Certainly.
Most growth shares are set with what they call a hurdle, which is basically today's value, but there are all sorts of other hurdles that you could put in. The important thing is that you want the shares to be worth very little now, so there is very little tax consequence on being issued with these growth shares, because the shares that are issued, there is an income tax charge on them. The trick is to keep it as low as possible. Mark suggested having the hurdle a little higher than today's market value, but if your company is rocketing upwards, then the revenue will argue that that growth is almost guaranteed. So you need to go a little bit higher than that sometimes, or have a different kind of hurdle. And the talk about what the hurdle is appropriate is really important. You want a hurdle that's possible to achieve, but unlikely possibly to be achieved, because otherwise you're going to have a very high current value to pay tax on, which is exactly what we're trying to avoid. We want a low current value with lots of upside for the person who's got the hurdle shares. He works hard, the company grows, his shares grow in value, and everything's marvelous. What you don't want is a high entry charge.
Thank you, Peter. And the other thing I'd point out is getting a very, very robust valuation is absolutely crucial. It's absolutely crucial. I mean, the only way that growth shares will be attacked, or the main way that growth shares will be attacked by HMRC, is that you've set the bar, this hurdle as Victor mentioned, at the wrong level. So the actual valuation is crucial. Moving on, EMI share options. So we're in a world now, particularly now with COVID, where it's desperately important to retain employees, to incentivize them, and there's lots of option schemes out there that Victor will refer to shortly or a little bit later. But the best one, the one that government has approved and the government brought out, is Enterprise Management Incentive, EMI share option scheme. Very, very, very tax advantageous. And it's an option scheme that enables companies to attract and retain really, really good staff. It's great for SMEs, and it's basically granting options here and now, so that on a particular event, those shares will crystallise, and the shareholders or the option holders will get real life shares and will hopefully cash in. Those real life events are things like the company being sold, Tottenham winning the league, that type of thing, a historic, important and big event. Okay. So good for startups. cash is often very, very tight. We deal with lots and lots of new startup companies, especially in the tech sphere. And in the tech sphere, options are quite common. And it's a great way to attract employees. Having options can provide more of an incentive than having shares in some cases, if as a result of having to sort of hit these specific targets. So they can be very, very, very incentivizing. And whilst I'm thinking about it, what we actually do for some of our clients, not all of them, some of them with EMI share option schemes, is that we'll do a valuation when the option scheme starts, and that we'll do in-house. My colleague Philip Tatum tends to do with those. And what you can do, if you like, is as a company, is actually revisit that valuation on a quarterly, 6-monthly, yearly basis. Now, the point of that is that you've got a company worth, let's say, the initial valuation is £500,000, for example, and someone's got options on for 2% options. So that on day one, that's effectively worth £10,000. What you can do is use the valuation methodology, the technique, and every 6 months, for example, look at the valuation of the company. Now, hopefully it's going up. So me, as having options for 2% of the company, I look in 6 months' time, my lovely employer does a valuation, and the valuation of the company's gone from £500,000 to £2 million, for example. So all of a sudden, my options, the value of my options has shot up fourfold. So I'm delighted. And for a lot of employees, certainly younger ones, they may not have ISAs and fancy pension schemes, etc. This could be the one big thing they've got. And if they've got options that are worth real money, 10, 20, 30, 50,000 pounds, that's to them, that's a real big incentive to help the company move forward. So that's something you can throw in, getting us or doing it yourselves, actually doing valuations quarterly, 6 monthly, so that the individual people who are party to the scheme can actually see what their options are worth. Very, very, very. Otherwise, what you'll do is you'll issue these options, and sometimes, I'm afraid, within several hours of issuing them and explaining to people what they're about, a lot of the employees will forget what they're about, not understand why they've got them. A lot won't, but some will. So by continually reinforcing they've got something of real value that within a few years' time they'll turn into real money is terribly incentivizing. Okay.
Absolutely right.
When they're granted, provided they're EMI share options, there's no tax charge. Now, if they're unapproved share options, I've got one at the moment where we've had to do an unapproved share option scheme. Tax is very, very messy. You end up with income tax, national insurance charges. The EMI is, I think, the only one out there, or one of the only ones out there, where there's no tax charge whatsoever when the shares are granted. When the shares crystallise, when they're sold, CGT may be payable, although I'm understood, Victor, that business asset disposal relief is also probably available. Yes?
Yes.
Thank you.
Normally, if the EMI shares are, if it's a valid scheme, then you're likely to come within the BADR provisions, giving you what used to be called entrepreneurs relief, i.e. tax at only 10%.
Which we'll touch on a little bit later. Okay. Next. So, can be used by independent quoted or unquoted companies. Gross assets have got to be less than £30 million, fewer than 250 staff, and important, you've got to work 25 hours a week or 75% of your working time, and up to £250,000 worth of shares granted to each individual, and the limit is £3 million under the EMI scheme.
Yeah, it's important to remember with the limits that you might start under the limit, but as time goes on, you go over the limit, and the scheme you can't use the scheme anymore. So, for example, the employee limit is the one we see that's normally the problem. A company grows, it gets more and more employees, and suddenly you go over the limit and you can't do EMI anymore. So you have to look at other share schemes, which I'll be talking about a bit later. EMI is not the only share scheme, but it is the Rolls Royce of share schemes. If you can come within it, then that's the one you want to go for.
Thank you, Victor. So, must be an employee. Sounds pretty obvious, but we've had lots of situations where clients have asked us, can a consultant Can a consultant be part of the scheme? Can someone working through their own company be part of the scheme? No, 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 no. Has to be an employee, has to work 25 hours a week, and the budget very sensibly made provisions for people who are furloughed. So they are now covered under the last budget. And also the individual can't have more than 30, it's got to have less than 30% material interest in the company. They've got to take on a qualifying trade, and there's lots of activities that don't qualify. Next slide, Kate, please. Mainly land, banking, finance, and unfortunately accountancy services are in there. But it's mainly land, finance stuff, and professional practices, that type of thing. Must be over topco. So again, very interesting. This you can have a situation where you've got a holding company and you have lots of subsidiaries underneath, and client comes to us and says, right, we want an EMI scheme, but only for a subsidiary company. Now, Philip Tatum's the man to ask on this, or possibly Victor, but there's a very, very clever way to do the share option scheme via topco, but specifically for a subsidiary. Quite complicated, but not impossible. And we're actually doing one at the moment like that. Got to be over fully paid ordinary shares, must be set out in writing, and capable of being exercised within 10 years. One sec, Kale. Very, very, very flexible. I think people need to appreciate the flexibility of EMI. You can word it pretty much however you want, provided it's within the scheme. But we've got so many variations. It really is a one size fits all, and fabulous thing to put in place. A fabulous thing.
Yes.
I think.
Although the conditions are,
sorry,
there are lots of conditions. Most companies can fall within them. It's not so complicated that it's restricted to only a few companies. Virtually, well, nearly all the share schemes that you come across these days will tend to be EMI schemes. There are others, but they tend to be in circumstances where you fall outside the EMI conditions. Yeah, the EMI scheme is the great thing. The share options over topco, it's called the independence criteria. The company you're issuing the shares in must be independent, i.e. not dependent on another company, so not a subsidiary.
And the other thing I want to emphasise is the individuals must be UK tax resident. And again, I've got a situation where I've got two individuals who aren't UK tax residents, and they don't qualify. Okay.
And in those circumstances, you'd probably use an unapproved share scheme. There are lots of different share schemes. You need to look and see which share schemes suit which individuals and which companies. It's not one size fits all. Yes, for most cases, the EMI scheme is the scheme of choice, but not always.
Okay, thank you. Alphabet shares. So Alphabet shares, very, very, very interesting, and we use them in lots and lots of situations. Third slide is the important one. The use of Alphabet shares could help a business pay shareholders different amounts of dividends depending on what class of share they own. So the way Alphabet shares work is as it says on the tin. You issue shares A, B, C, D, etc. New company, or possibly a new company starts up, 5 people set the thing up, and they're all going to be doing different stuff, and it's agreed amongst them that they're going to generate different amounts for the company. Their contribution's going to be different, and they're going to help the company in different ways. And it's felt that though they should have 20% each, the dividend flow from those shares should possibly not be 20% each, and therefore Alphabet shares helps with that. So you end up with A, B, C, D, E shares, and it may be that as dividends flow, the A shareholder gets 30% of the dividend, the B shareholder 15%, etc. As the directors agree amongst, and in a case like that, the directors and shareholders are probably the same people as they agree. So, but broadly speaking, it facilitates different level of dividends amongst the different Alphabet shareholders. Okay. That again, you'll need to ensure that it's all dealt with properly in the Articles of Association and the paperwork. There's a slide there referring to the dividends I've just mentioned. Next, Kate. New classes of shares. Yep. That's fine. There's lots of forms to do. Next, Kate. the risks. So you've got to be sensible on these things. Can HMRC look at it and sort of say, well, this was all done for tax avoidance? Possibly. You've got to be very, very sensible. I mean, there's a very famous case, PA Holdings case, where HMRC ended up winning the case against the company. But as long as it's dealt with relatively sensibly, there shouldn't be any tax issues. Okay.
It's important when you do alphabet shares, and they're normally best set up when the company is actually created, that you're paying the right amount for each share. If you're paying a small amount for the shares, but they're going to get all the dividends, you're going to run into trouble. You need to pay a right market value for the shares you're going to get. Right at the beginning, when you don't know what's going to happen, the company's just starting, you can set up any kind of share class, and you'll probably be fine. But if you try and set up an alphabet share scheme in the middle of a company's life, you're going to have difficulty getting the values right, and you may well end up with big arguments with HMRC. It can be done, but alphabet shares are best created right at the beginning of a company's life.
Thank you, Victor. So Victor's going to take over in a sec, but very, very briefly, the heading there is employment-related securities legislation, and I touched on that earlier. Broadly speaking, if you're an employee and you get shares in a company at an undervalue, you will be zapped for tax and national insurance. So that's what employment-related securities legislation means. The ways around that are possibly going via share schemes, which Victor will touch on now.
Yeah. Well, their share schemes fall into sort of a number of categories. Some are tax approved and some are non-tax approved. The tax approved ones are obviously the way to go, because the revenue goes softly on them. You get all the tax advantages, no tax on entry, only capital gains tax on exit. They work very well. Some of them are actually real share schemes. You get shares now. Some of them are just option schemes where we talked about one of them, the EMI scheme, which is an option scheme. There's also something called a CSOP, a company share option plan, which is the second best kind of scheme if you can't do an EMI scheme, maybe because you've got an employee who doesn't work enough hours, maybe because the company doesn't qualify under the EMI rules, and that can give you some very good tax advantages. Otherwise, you're talking about all employee schemes like the share incentive plans and the save as you earn plans. If you don't want to do a tax approved scheme, you can do an unapproved scheme and set them up so that there is not much of a tax disadvantage, but you really want to do a kind of scheme that has a very low entry charge. Once you accept that there is going to be an entry charge, like with a growth share, for example, you need to say, what are we going to do here to keep that tax down? Growth share is an idea, flowering share schemes are other ideas. There are a number of schemes you can do, even if they're not tax approved, that will fit your bill, often perhaps for non-resident people, perhaps if you've got a company that just doesn't qualify under any head and you want to do a scheme, a flowering share scheme can be very motivating. But as I said, they fall into the categories tax advantage and non-tax advantage, and either directly giving people shares or through options. But behind it all, there is the employment-related securities legislation, which effectively says, look, if you get something, you pay tax on it. You get free shares at the beginning, you pay tax on them. Something happens in the middle, you pay tax on it. Something happens at the end, like you sell the shares, you pay tax on it. You don't want to pay income tax on that. You really want a capital gains tax charge at the end. But there's a lot of anti-avoidance legislation that you just have to be careful about. Right, any share, I mean, it's not just an ERS tax return is basically, it's not what it used to be called, it's what it's called now. You have to report to the revenue on all shares being issued so that they know what shares are being issued and they can have a look and see, should there be tax payable on this share issue? And it's really important that this return goes in on time. They've got to be in by 6th of July. It's done electronically these days. It used to be a handwritten form, but the reporting is essential. You get into serious trouble if you don't get these forms in. There are penalties, and it's just part of the compliance. You do share schemes, you are talking about dealing with compliance, and don't fall down on your compliance obligations.
Yeah.
Next slide, please.
Okay, so before we touch on passing on shares to family member, I want to talk about briefly about Enterprise Investment Scheme and CDIS. Because of a technicality, I'm afraid there's no slides on them, but I will go through them for you nonetheless. So Enterprise Investment Scheme, that was brought in 1993-94, believe it or not, and it took over the old Business Expansion Scheme, which was a bit before my time. Actually, it wasn't before my time, I don't think. Thus far, £20 billion has been raised. Very, very good. Issuing shares under EIS. You can carry back the investments the prior year, provided they're held for 3 years. They are capital gains tax free. You get 30% income tax relief on the investment, which is terrific. Maximum £1 million or £2 million in what's now called knowledge intensive companies. You can transfer them between husband and wife within the 3-year period without any problems. If they're held for more than 2 years, they will be inheritance tax free. Interesting new rule came in quite recently that the investment under EIS to actually qualify needs to be made within the first 7 years of the company's life. That never used to be the case. And I've come across 1 or 2 situations where people have actually been caught out on that. If it's, again, a knowledge intensive company, then that extends to 10 years. Few regulations, got to be less than 250 employees, gross assets less than £115 million, and you can raise up to £5 million each year or £12 million during the company's lifetime. Now, if you issue shares under EIS, if the EIS shares are in place, and you endeavour to issue growth shares that I mentioned earlier, the issuing of growth shares can cause major problems for the EIS shares. In fact, I think the EIS relief can get withdrawn. And you've got to be very, very careful. Very obscure legislation. So again, a lot of people, I imagine, will get caught out by that. So again, if there are enterprise investment scheme shares in place and you endeavour to issue growth shares, you will probably bugger up your EIS shares. So be very, very, very careful. Next, seed EIS. That was brought in a few years ago. That's even, well, can be even better, 50% income tax relief, and that includes directors. Up to £150,000 per individual, or the company can get in £150,000 per company per year. Again, if the shares are held for more than 2 years, inheritance tax free. This is for startups, so the company's got to have been trading for less than 2 years, less than 25 employees, and gross assets of less than £200,000. So for small new companies. One more, whilst I've got the stage. Business investment relief, nothing to do with the EIS or CDIS. Business investment relief. So this relates to people from generally other countries, so non-DOMs who are now UK tax resident. This came in 6th of April 2012. If when you've come to the UK as a non-DOM, you've done your stuff correctly, you will have what's called a clean capital account. That means monies that, broadly speaking, have accumulated before you came to the United Kingdom, and you can bring those monies in without any tax issues. A bit more complicated, but that's the long and short of it. If you've got other funds, those other funds might be what's called tainted, because they may have income and gains that, if brought into the UK, could be taxed in the UK. And the tax authorities, or the government rather, took the view that it was daft stopping people bringing that money into the UK, because that money could be used for investing in growing companies, for example. So they brought in what's called business investment relief. And what it basically means is that the money that otherwise could get zapped for tax because it's got income or capital gains in it, will get business investment relief provided it's invested in a trading company within, I think, 45 days of it coming here. And that means you can invest in that company, that trading company in the UK, and HMRC will not look to you for any income tax or capital gains tax they possibly otherwise would have done. Yes, Victor, any further?
Well, there are rules about how quick, you have to bring the money in, you have to invest it quickly. The company's got time limits on on how it uses the money and what it uses the money for. And obviously you mustn't just pass it straight out to yourself, because that will invalidate the rules. And when it eventually does come out of the company, you have to get it out of the country fairly sharpish as well, because the point is that this is income or gains which was made abroad, and that would normally be taxable if you brought it to the UK. To stop it being taxable, you have to use the BIR relief, and then when you don't need the BIR relief anymore and it comes out the company, it has to go back abroad. So the principle is you're bringing something in which would normally be taxable. It's specially not taxable as long as you comply with the exact rules of the BIR relief. But it does allow you to bring in a whole ton of money which otherwise might have been blocked abroad, and now you can bring it in, invest it in a company, and the range of companies is fairly broad, including property companies. So this is a very useful relief.
Thank you. So we're going to very briefly discuss passing on shares to a family member. I think, right, next slide, Clay, please. The important thing on transferring shares across, I think for me the big one is holdover relief. So father to son, for example, or father to daughter, if the shares are transferred without any reliefs, then capital gains tax will be payable, which you don't want. So by having holdover relief, relief signed by both the transferor and the transferee, no CGT changes will need to be paid, and the person getting the shares, that will be the son, will pick up the base value of the father. So as and when the son ultimately sells the shares, there'll be presumably a big gain if dad set the thing up or got those shares many, many, many years ago. There's mentioned there, which I'm going to touch on shortly, for inheritance tax purposes, a gift from one individual to another is potentially exempt. But if it's in a trading company, it falls under the business property relief rules, which I'll touch on in a second. Okay.
Yes, it's quite important that these, whether the shares are shares in a trading company or shares in an investment company, business property relief is normally restricted to shares in a trading company unless the transfer itself bears inheritance tax. For example, a transfer to a discretionary trust. But you need trading company shares. You tend to need trading company shares to get your business asset deferral relief, your BADR, and you tend to need trading company shares to get your inheritance tax business property relief. That is the kind of company that matches all the reliefs. If you haven't got a trading company, you have to look carefully to see what reliefs are available to you, and you may find that you just are not eligible for holdover relief. You're not eligible for business property relief, and you're not eligible for business asset disposal relief. So there you are. It's trading companies is a feature of virtually all of these reliefs.
Thank you, Victor. So just a few more words on business property relief. So as Victor quite rightly said, it's trading companies. Shares have got to be held for 2 years, just over 2 years, and broadly speaking, there will be no inheritance tax if their trading company or trading entity, could be a partnership, business, shares are held for 2 years in a day, then zero inheritance tax. And that includes the AIM market, alternative investment market, which is interesting. Now, the enormous, there's enormous companies out there, the ones that come to mind, Ingenious, Octopus, we're not allowed to recommend, so none of those recommendations. You want to speak to our IFA friends on those. They have enormous funds with billions and billions in them. And they may be appropriate for elderly people who have done no inheritance tax planning whatsoever. And broadly speaking, you know, we get a 90-year-old, 85-year-old client who's done no IHT planning whatsoever. And by putting their money into one of these business property relief funds, it means that 2 years and a day, it's free of IHT. They're very boring, these funds. The idea is not to make super big gains or profits. It's to basically retain the capital. And if the capital is retained, you are effectively 40% ahead. And they're really good for people who are elderly and think that if they start giving stuff away, they may not live, unfortunately, for 7 years, but they think they've got at least 2 years life in them. So BPR qualifying investment, speed, you're done 2 years and a day. And with these big investments, the individual, the 85, 90-year-old, still effectively owns and controls the money. again, really, really important, because we come across a lot of elderly clients who understand they need to do something for inheritance tax, but actually don't want to give away their stuff. And we explain to them in great detail what they can do and how they can do it. And when it actually comes to transferring their stuff to their kids or whatever, they get a mental block, and they don't want to. So by putting their money into one of these qualifying investments, they retain control, and after 2 years and a day, out effectively 0% inheritance tax situation.
Yeah, I agree with Mark. A lot of clients says, I've spent my whole life building up this portfolio, and you just want me to give it away. I don't think I can do that. And it takes a great mind shift to move from having built all this up and held on to it to giving it away. It can be difficult. And this, if they're happy with using BPR, either through the AIM market or through a portfolio of unquoted shares, then that's good. But it can be a problem detaching elderly people from their investment portfolios. If they don't want to do it, then it's their money, their choice.
So be it. Okay. So the risks, they are, I did mention that these investments, they tend to invest in dozens, if not hundreds of companies that are really boring and shouldn't really fly up or fly down. But as with any investment, the value can go down. As I say, this is more for our IFA friends. We're not allowed to recommend this stuff. So please, please, please speak to them. Okay. Business asset disposal relief, previously known as entrepreneurs relief. So under entrepreneurs relief, you could make a gain of £10 million, 20 million for a married couple, and only pay 10% capital gains tax, as opposed to 20% that you'd otherwise pay. The government thought that was a bit too generous, so they brought in business asset disposal relief. So what are the rules and regulations on that? The amount has come down to £1 million. In other words, you can get £1 million at 10%. The rest of it will be at 20%, but only provided you haven't used up you haven't done it previously under entrepreneurs relief. So if you have, it doesn't really apply to you. You've got to have 5% or more of a company. You've got to be an employee, director, or officer. And it's got to be, as Victor said before, a trading entity, and you've got to have had it for more than 2 years. That's probably it.
Yes.
Now, sorry, go on. Carry on, Victor. Sorry.
If you've done a share scheme like an EMI scheme, there are relaxations on those rules, because to own 5% of a company is quite a lot of a company. If you're a founding shareholder, that's obviously not a problem. But if you're an ordinary employee who's acquired shares, perhaps through a share scheme, you're unlikely to qualify for BADR, because you won't get that 5%. You won't reach that 5% hurdle. But the EMI scheme in particular says that doesn't matter. You'll still qualify for business asset disposal relief.
And if I may say, the 2 years only came in quite recently. It was originally 1 year, and you had to own the shares. Now it's gone up to 2 years. So they're clamping down a teeny bit. Still very generous, though. And it applies to sole trader, partnerships, companies, joint ventures, etc. And as I've mentioned, it's available to individuals generally, and it's qualifying disposals. So those slides there really refer to what I've mentioned before, £1 million from 11th of March. And those are the figures from before that. The mechanics have changed, but broadly speaking, what we've got in place is similar-ish to entrepreneurs relief. And that's it. We're done in 40 minutes.